All right, let's talk about a financial product that honestly sounds like it's completely backwards, the reverse mortgage. It's a concept that can really mess with your head at first, but you absolutely have to understand it, especially if you're gearing up for that MLO exam. So, let's get into it. I mean, just stop and think about that for a second. We spend our lives paying the bank for our home. But what if we could flip that script entirely? What if your house started paying you? That right there is the wild idea we're going to unpack today. Okay, so here's the official breakdown. A reverse mortgage is a special kind of loan for older homeowners, letting them turn the equity they've built up over decades back into spendable cash. The two biggest things to catch here: you get cash in your pocket, but your loan balance actually goes up over time, not down, precisely because you're not making those monthly payments to the lender.
So how in the world does this actually work? In this first part, we are going to break down the absolute fundamentals, the basic mechanics of how a reverse mortgage ticks.
First things first, burn this number into your brain. 62. This is the magic number. It's the minimum age a homeowner has to be to even think about getting a reverse mortgage. It's a hard and fast rule, and you can bet it'll pop up on the exam.
This slide right here is perfect. It shows you the whole concept at a glance. Think of it like two escalators going in opposite directions. With your normal, traditional mortgage, every single payment you make lowers your debt and builds up your equity. A reverse mortgage, it's the complete opposite. As you get cash, your debt goes up, and your slice of the home's value, your equity, goes down. It's a total reversal of cash flow.
So you're probably wondering, if I'm not making monthly payments, when does the lender ever get paid back? Well, here are your answers. The entire loan becomes due when one of these three things happens. You've got to memorize these triggers. The house gets sold, the owner permanently moves out, like into a nursing home, or when the very last borrower on that loan dies. Okay, now that we've got the basics down, let's get a little more specific. Reverse mortgage is kind of the umbrella term. The one you're going to see pretty much everywhere in the real world, and definitely on your exam, is a specific type called a HECM. HECM, that's HECM, stands for Home Equity Conversion Mortgage, and the most important part of that whole phrase is FHA. This is the version that's insured by the Federal Housing Administration, and because of that, it comes with a whole bunch of specific federal rules and, importantly, protections for the borrower.
So what are these rules? Well, you still have the age requirement, 62 or older. The property absolutely must be your main home, your primary residence. No vacation spots or rental properties. And this last one, this one is huge. The borrower is required to get HUD-approved counseling before they can even fill out an application. It's a safeguard to make sure they know exactly what they're getting into.
You know, a really key feature of the HECM is how flexible it is. The homeowner doesn't just get one giant check and that's it. Nope. They can choose to get their money as a one-time lump sum, as a steady monthly check for the rest of their life, as a line of credit they can dip into when they need it, or even a combination of these things. Now, getting money every month without having to make a payment sounds like a dream, right? But it's not exactly a free ride. Let's look at the other side of the coin, the borrower's responsibilities and the really important protections that are built into these loans. This is so important to remember. While you don't have a monthly loan payment, you are still the owner of the house, and that means you're still on the hook for all the normal costs of owning a home. Paying your property taxes, keeping up with homeowners insurance, any HOA fees, and just generally keeping the house in decent shape. If you fail to do these things, you could actually default on the loan.
Okay, if there is one term you absolutely positively have to know from this whole explainer, it's this one: non-recourse loan. What does that mean? It's basically a massive safety net. It means that if the housing market tanks and the loan balance balloons to be more than the house is worth, the FHA's insurance fund eats that loss. Neither the borrower nor their kids will ever owe more than the home's fair market value. It's a huge protection.
Whew, okay, we have covered a lot of ground. To make sure all this stuff really sticks in your brain, let's put these different loans side by side and do a direct, head-to-head comparison. Seriously, you might want to screenshot this slide. This is your exam cheat sheet right here. Just look at the flow. A traditional loan's purpose is to pay down debt. A reverse mortgage's purpose is to tap into equity. The payment flow is completely opposite. But pay close attention to that HECM column. See the mandatory counseling, the FHA insurance, and that last row? Those are your buzzwords. If you see a question that mentions HUD counseling or non-recourse, your brain should immediately scream HECM. All right, knowing this stuff is one thing. Being able to remember it under the pressure of the exam is a whole other ballgame. So in this last section, let's load you up with a few simple memory tricks to lock this all in for good.
For the general idea of a reverse mortgage, just spell out the word reverse. It literally tells you the story. The borrower is typically retired. They turn equity into cash. The value they owe grows over time. It's for an eligible primary residence. It's repaid when the borrower leaves. And the S&E remind you they have to stay current on taxes and insurance and be educated with counseling. It's all right there.
And for the HECM, the specific FHA version, just use its name, HECM. H for the mandatory HUD counseling. E because you're eligible at 62 or older. C for the flexible cash-out options. And M because the mortgage is insured by the FHA. So simple, right?
And look, if you just need something super fast to trigger your memory in a pinch, here you go. Think T for traditional. You take money out of your wallet. Think R for reverse. You receive money and repay when the retiree leaves. And H for heck. HUD counseling is required, and the home has to be their primary one. These little phrases can be lifesavers.
So, there you have it. We've broken down the definitions, the rules, and the memory hacks you need to feel confident on your exam. You're ready to nail any question about a reverse mortgage or a HECM. But let me leave you with this to think about. Beyond the test, what's the real-world impact of a financial tool that is literally designed to shrink a family's biggest asset? Something to chew on. Thanks for watching.